All right, you want me to take over?
Good morning, everybody, and welcome to Marketing Matters. This is our weekly webinar brought to you by Landmark Title. I'm Sarah Touchstone, our social media marketing strategist. I'm joined today with Andrew Kish of Citywide Home Loans. I had the pleasure about 2 weeks ago of attending one of Andrew's reverse mortgage classes in person. Yes, guys, in person. I know you see us on the talking head camera a lot because we do a lot of webinars at Landmark Title. However, in-person classes are back, and Andrew's presentation was absolutely awesome. So how many of you out there have been stuck in a reverse mortgage situation and you're like, this is the worst thing ever. This takes way longer. This is not going smoothly. Guys, there's hope. It's actually an amazing, amazing mortgage for people who qualify. And Andrew is the expert. So if you've ever been in a situation before with a reverse mortgage, with somebody that maybe is not an expert in doing it, yes, things can get a little sticky. Waters can get a little muddy. However, when you're dealing with somebody that knows this program inside and out, it is an absolutely fantastic program. So Andrew, I'm going to let you take it away and really give us this, amazing education on how great this can be for our clients, who qualifies, and why we need to be educated about it and utilize it.
Fantastic. Well, thank you, Sarah. I really appreciate the opportunity to be here this morning and talk to you about reverse mortgages. As Sarah said, my name is Andrew Kish. I'm with Citywide Home Loans, and I do have a bunch of content that I would like to go through today. And since there is quite a bit, I am going to try to run through it pretty quickly so that we can keep it within the time frame. We will have an opportunity for some questions at the end. And we will get going. Are you able to see my screen okay?
I am. I see your next
the wrong
slide.
Screen? Yep, okay. 1 second here. And of course, that's the way it wants to do this, huh? Okay, let's try this.
Now I see just a big purple box.
Keeps wanting to do that. Apologize here. There we go.
Yeah.
How's that?
Perfect.
Okay, let's jump right in. All right, so first of all, what I want to do today is I want to focus on the HECM. The HECM is the home equity conversion mortgage. It is actually a subset of a reverse mortgage. So a lot of people will talk reverses. There are a lot of reverse products out there. There are some proprietary products. I'm not going to get into a lot of the details on those. I'm going to really stick today to specifically the HECM, which is the FHA insured loan. So a lot of the details and things I'll talk about, but if we want to explore some other options, other products, I'm happy to do that with folks, separately. So firstly, common challenges that seniors can have in buying a new home. So some of the things that we come across is the ability to qualify for traditional mortgage. Once they're seniors, once they're retired and they don't have that full-time income coming in any longer, they may have some issues qualifying for the size of traditional mortgage they would want to get for the type of property they want to get. They may have credit issues. They may have a lower FICO score. They may have some other delinquencies and some other issues with their credit that would create challenges in them qualifying for a traditional mortgage. While there are credit requirements, they are quite a bit more relaxed or easier to qualify for when it comes to the HECM. Other issues could be that they have a desired house that they would want to purchase that's more expensive than what they believe they can afford in terms of what they have the cash on hand for or what they could qualify for on a regular mortgage. They're hesitant to liquidate a significant amount of their retirement savings in order to purchase that property, or they're contingent on selling a current home because they don't have the actual cash assets on hand. So they're going to be in a contingency position, and we'll talk a little bit about a scenario on how we can help alleviate that. There's quite a few common myths out there about reverse mortgages. I'm sure that a lot of you have heard these before, maybe heard some additional ones, but just to run through a few, the reverse mortgage sells the home to the lender. It's probably one of the biggest misconceptions that we hear, from potential borrowers, that they feel like they're selling the house to the lender, to the bank. They no longer own it. But a reverse mortgage is just like any other mortgage. You still hold title to the property. You have a debt, that you're incurring it with a lien against the property, just like any other mortgage. The homeowner could get forced out of the home. So that's probably the biggest concern, is that at some point in time, the lender is going to kick the homeowner out, either because they run out of equity, or, they're not meeting their obligations, etc. There are a lot of protections in place. Again, with the HECM being FHA insured, there are a lot of protections in place from the FHA that protect the borrowers and prevent this from happening. And we'll talk through some of those throughout the presentation. The heirs will not inherit the home. Heirs are beneficiaries. Again, the ownership of the home remains with the borrower, title remains with the borrower, and just like in a normal situation with a traditional mortgage, if that borrower would pass, then the title and the property does pass on to the beneficiaries, and then they would need to figure out what to do about the existing loan that's on the property, refinance it, pay it off, etc. I mentioned this earlier, you can outlive the equity in your home and be forced out. Again, I'll talk a little bit about that. It's very unlikely, but there is possibility, given market conditions, that a borrower could be upside down in the equity in their property at some point down the road. But that would not trigger any kind of, situation where they'll be forced out of that property. Social Security and Medicare be affected. Again, there's concerns there. Pulling proceeds out of a reverse mortgage, are not tax deductible. That's actually the next point. So, none of that affects Social Security, Medicare, taxes. All of these things are not affected in this situation of a reverse. Large out-of-pocket expenses. So there's a perception that reverses are extremely expensive. Again, you will touch on that. I think it's more of an issue of timing. So there are some larger upfront costs. But most of those costs can be defrayed, and actually built into the loan. They're not going to be actual costs that are out of pocket for the borrower, at time of getting the loan, and we can talk about that. Bottom line one here is that some people think that a reverse mortgage is similar to a home equity loan, but more expensive. So why would I do a reverse when I can do a HELOC? Again, there's significant differences between a reverse and a HELOC. There's a lot of protections in place for reverses. Reverses don't need to be repaid, whereas a HELOC does. HELOCs don't grow over time. You can have a credit line with a reverse that does, and HELOCs can actually be taken away or reduced. So the lender can review those over time and actually reduce or eliminate those. You cannot do that with a reverse, but that's getting into some other things that we're really not going to cover too much today. I mentioned some of these things earlier, but just to summarize, there are a lot of protections in place for seniors and folks that are getting reverse mortgages. Number one, they're a non-recourse loan. So again, if there is a situation where there is debt, more debt on the property than the property value, that debt is not going to transfer either to the borrower if the borrower moves out, moves into assisted living, or to the borrower's beneficiaries. So again, the FHA insurance, will cover that difference. There is HUD mandated counseling, so similar to a traditional FHA loan for a first-time homebuyer. For reverses, they do mandate counseling for all borrowers so that they have a full appreciation and understanding of what they are signing up for. There's no prepayment penalty on a reverse. So again, you do have the opportunity to either pay off or refinance a reverse at some point, just like you would with any other loan, and there is not a penalty, for doing so. There's the pre-counseling, there's application and closing disclosures, as well as required redisclosing. There are a lot of disclosures, more disclosures in this process than with a traditional process. And again, that's all aimed at protecting the borrower, making sure that they fully understand exactly what they're signing up for. There are options for both fixed rate and interest rate caps on adjustables. Yeah, we'll be talking mostly about the fixed rate today, because in a HECM for purchase situation, you're going to be talking about a fixed rate lump sum, but there are adjustable rates and interest rate caps in those cases. There's origination fee caps. So HUD has dictated what the origination fee should be based on the home value. There are protections for non-borrowing spouses. Let's spend a second on this one. So one of the primary qualifiers for a reverse mortgage is age. And so for the HECM, you have to be at least 62 years old to qualify. Now, if you do have a situation where you have one spouse who is over the age of 62 and the other is under the age of 62, in that case, what you have is what's called a non-borrowing spouse. So the younger spouse would not actually be a borrower, but would still have all the same protections that the borrower has. And I'll elaborate a little bit more on that later. But so you'll hear that term non-borrowing spouse, and that's what we're referring to. And finally, there's an analysis of capacity and willingness to ensure sustainability. So basically, when we qualify a reverse borrower, it's looking at income, but again, it's a limited income. So we'll talk a little bit about what that income requirement is. That's your capacity piece. Then on the willingness side, again, we do have a credit qualification process, but it's different than what we would do in a traditional mortgage. It's not so much tied to the FICO score. It's tied to demonstrating that they have been consistently paying mortgage payments if they have an existing mortgage, property taxes, insurance, HOA dues, etc. So as long as we can demonstrate that they are paying those in a timely fashion, that's the main criteria for qualifying on credit. So using a HECM for purchase, why do we want to do this? What are some of the benefits of doing this? So a great product for borrowers who are downsizing. So you have a borrower who has the family home that they've raised their family in. They either have it paid off free and clear, or maybe they still owe a small mortgage on it, but now they're ready to downsize, sell that property. They take the proceeds, and in a lot of cases, go and use that cash to purchase a property outright. That's a great scenario for where a reverse can come in and help to minimize the amount of that equity that they have to put in the next property, and we'll talk about that. Gives the borrower an ability to upgrade their purchase. So I'll talk through a case study that talks about a borrower that has a certain amount of assets, but would actually like to buy a home that's a little bit more expensive than what they really have. And so the HECM is a great tool to enable them to do that and buy a more expensive property, the more appropriate property for what they're looking for. I mentioned already they can conserve assets. So rather than using all the proceeds from their prior home or from investments, they can conserve their assets by using the HECM. They're going to help their cash flow situation in retirement. So for people that are on a fixed income, this is a great aspect or feature of the HECM, is that you don't have to make P&I payments for the life of the loan or for life, basically, of the borrower. And I'll talk a little bit about that in some case studies. Great solution for snowbirds who might be looking to relocate their primary residence to Arizona. And I say that specifically is they don't necessarily need to be relocating to Arizona permanently, but if they're going to relocate their primary residence to Arizona and at least spend half the year here, then the HECM could be a great solution for them. And I'll talk about a case study on that as well. Something newer is that seller concessions, credits, or seller paid closing costs are allowed when reasonable and customary for the market. That is actually something that was not permitted in the early days of reverses, but that has changed here in the last couple of years, and then we can accommodate that in purchase transactions. And then max claim amount, just to explain what this is. So there is a max claim amount for the HECM for 2021. That's going to be $822,375. That's similar to what we talk about as kind of the max loan amount on a traditional conventional mortgage. So what that would mean is, if you have a property value below the 822,375, then your max claim amount will be the appraised value of the property. If you have a property that is more than 822,375, let's say $1 million for argument's sake, the max claim amount on that property would then be the 822,375. So if we start getting into properties that are much higher value than this, that's when we start getting into the discussion around the proprietary products. Think about it as a reverse jumbo. But again, I'm not going to get too much into detail on that today. We can discuss that another time. So really just to illustrate some of the concepts here, I think I've touched on a little bit, but I think this kind of summarizes it very well. There's really three ways you look at buying a property, and especially when you're talking about somebody that's in retirement, and buying that retirement home, not a retirement home, but retirement property. One option is all cash, right? So people don't want to have to worry about mortgage payments in retirement. Again, they've probably sold their prior house, maybe they're downsizing, so they have the cash. They'd rather just pay all cash and not have to worry about future mortgage payments. Obviously that limits the amount of reserve funds that are available to the customer, that they can keep in savings. It also limits the cost of the property they can purchase, right? This is going to be based on the proceeds that they have available to them. The second option, traditional mortgage, right? So now you make a minimum down payment and limit your upfront investment. Then you also build equity over time as you're paying down that mortgage. Again, the challenge there is that it's going to be an income issue, right? So what can they afford on a monthly basis on that traditional mortgage, which again may limit the cost of the property they can purchase, or the amount of loan that they can qualify for. And the third option is HECM for purchase. So there's quite a few features why you would want to do this. I mentioned previously, there's no required monthly P&I payments, so significantly increases cash flow in retirement. And we say P&I payments specifically because you still have the obligation of property tax and insurance, and if you have an HOA fees. So those are the things that would be, you would still have obligation to make sure that you're paying, but you don't have the principal and interest payment associated with the mortgage. You have the flexibility then to buy the home that the borrower really wants. Again, could give us flexibility to buy a more expensive property, and I'll run through a case study on how that works. It also enables the borrower to keep more of their liquid assets or assets that might be tied up in investments, and they don't have to then liquidate those. It does require a larger monetary upfront investment than compared with a traditional mortgage, and I'll kind of go through that. Roughly, ballpark is 50%, right? So you basically come to the table with 50% of the cost of the property, and then you can get a reverse for the other 50%, give or take. It's based on age, and we'll go through that. Here's a example just kind of showing for a couple different cost properties based on age what would be required. So if we look at the top row here, for a borrower that's going to be age 62, if they wanted to purchase a $500,000 property, look all the way to the right hand side, they would need to come to the table with $297,087. And then they could get a HECM, which would cover the remainder. So a little over $200,000 worth of that. The older the borrower gets, the more they can borrow. So if you look down to the bottom row, for a borrower who's age 75, purchasing that same $500,000 property, they only need to come to the table with $257,587. They can then get a HECM for the rest, so almost 50%. Again, this is just illustrative. We have, by every age, this table will change, and it's based on age, and it's also based on the interest rate of the loan. But this is just to show an illustration of how that would work. So who is eligible? I've alluded to this a couple times, but to be clear, the primary qualifier is age. So you have to be 62 years old to qualify for the HECM. There are proprietary products out there that actually go as low as 60 years old. But again, for the HECM, it's 62. And as I mentioned previously, as long as one of the borrowers is age 62, you're fine. Then the second borrower would just be the non-borrowing spouse. The second qualification is you have to live in the home as your primary residence and plan on continuing to live in the home. So I alluded to that earlier is, even in the snowbird situation, if they are going to establish Arizona as their primary residence, then they can qualify for the HECM. But if it's only going to be their second home, part-time home, they're only going to spend a couple months out of the year here, then that's not going to work. And they need to be able to still pay their property taxes, homeowners insurance, and HOA fees, and maintain the property, in good condition, right? So, those are the situations similar to a traditional mortgage. If you do become delinquent on your taxes and, homeowners insurance, et cetera, and liens are filed against the property, that would be grounds for the lender, to look at a foreclosure process. But again, that's really no different than a traditional mortgage situation. So what types of homes are eligible? Your eligible properties are going to be your single family homes, your FHA approved condos, townhouses and PUDs, 2 to 4 family homes, or manufactured homes that meet HUD guidelines. Non-eligible properties, clearly investment properties, and as I just alluded to, vacation homes, second homes, co-ops, B&Bs, those are not going to be eligible properties. So it definitely has to be the primary residence for the borrower. It cannot be any kind of, secondary or investment property. So I'm going to run through a few case studies that hopefully will kind of take a lot of these concepts and information and boil it down into a couple stories that it'll help you understand things a little bit better. So first case study is the buyer who can't qualify for a traditional mortgage. So we have Raquel. She's age 67. She wants to buy a condo for $400,000. She has $225,000 liquid assets, and she is on Social Security. Her only income is Social Security. It's about $1,200 a month. So if she was to do a traditional purchase, she would need to qualify for a loan for about $175,000 plus closing costs. When you run the numbers on that, even at the best rates that we're seeing today, she's not going to qualify for that loan on a $1,200 a month income. Alternatively, she could put down her $225,000 cash. She can get a HECM then for the remaining $175,000 plus the closing costs. And the benefits of that, she's able to buy that $400,000 property essentially for $225,000. That's her cash out of pocket. She has no monthly P&I payments for the rest of her life. So her $1,200 a month income will be plenty to cover just the property tax and insurance and her living expenses. She can live in that home for life, and the loan doesn't have to be repaid until she either sells the home, moves out of the home, and I'll add there for 12 months. So basically you have a 12-month period. If you do have some seniors that have some medical issues where they have to go spend a couple months in a assisted living or rehabilitation centers, that's fine. But once it passes the 12-month period, that's where it could become an issue. So basically the requirement is you have to be in the home you can't be out of the home for more than 12 months. And then obviously passing away. So those are the situations where then the loan would become due. Once the loan is repaid, any remaining equity would go to Raquel or her beneficiaries. So she could take out that reverse, for the the 175 plus the closing costs. Obviously, interest is going to accrue on that loan over time. But if down the road she would want to move and sell the property, she can, and whatever equity is remaining, she gets. Or if she passes, then the beneficiaries get the property, and they have the ability to then, refinance that loan, sell the property, keep their equity, etc. Again, if the loan balance exceeds the property value, there's no debt obligation for her or her beneficiaries. Second case study, helping a buyer downsize better. So we have Jack and Kathy, age 71. They raised their family in a large home, now ready to downsize to a nice condo with amenities and proximity to dining and shopping. So their home is worth $800,000. They own it free and clear. So they're going to net about $750,000 from the sale after commissions and fees. So from those proceeds of selling their house, they want to buy a condo for about $500,000, but they'd like to retain as much equity as they can. So their option is to put down 270 and use a HECM for the rest. They're able to then preserve $480,000 of their equity, so they can put that in the bank, invest it, whatever they want to do with that. They don't have to make their monthly P&I payments, so they have that flexibility, and they have the ability to live in that home for life. And the loan doesn't have to be repaid until they either sell the home, move out, or pass away. Similar to before, any equity remaining goes to them or their beneficiaries, and their obligation is property tax, insurance, HOA, etc. Case study 3, helping the buyer upgrade to a better home. So here's a situation where you have Carlos and Rita, age 62. They have about $300,000 in liquid assets. They'd like to pay cash for a new home and avoid their mortgage payments. So they think they can only afford a $300,000 property. But with the HECM, they can actually afford a property up to $500,000. So they could put $297,000 down and then use a HECM for the rest. Again, the benefits, they can buy a more expensive home that they want. And then, similar to what we've talked about before, no P&I payments required. They have the ability to now live in that home for life, and until they sell, move out, or pass away. I'm not going to keep reiterating these, as I'm conscious of time. So I'm going to move on to the next one. Snowbirds relocated to Arizona, so kind of a case I mentioned earlier. So you have Bill and Joanne, age 75. They own their home in Wisconsin, free and clear, worth $400,000. They've been spending winters in Scottsdale for a few years, and now they want to relocate to be closer to their grandchildren. So they find a condo they love for $500,000, but they want to pay cash, and they only have $376,000 net proceeds from selling their home. So again, with the HECM, they only need $257,000 down. That enables them to get the property they want, while still keeping close to $120,000 worth of their proceeds. Again, all the same things apply. No P&I payments. They're guaranteed to live in that house for life, and they have the same obligations that we've discussed previously. Case study 5. This is an interesting one, creating the cash buyer. So specifically in this market, we know that there is a lot of competition to purchase property right now, and so having a contingency on selling your prior home is a detriment. So in this case, you have David and Linda, age 70. They own their home that's worth about $822,000 free and clear. They want to buy a condo for a purchase price of $400,000, but in this market, again, they'd be disadvantaged with a contingent offer. So they take out a reverse mortgage on their existing home, which enables them to pull out about $440,000 of equity to make a full cash offer on that $400,000 property, and even have an extra $40,000 if they need to negotiate, or if they need to offer over ask. So they've got some flexibility there. After they close on their new home, then they can put their existing home on the market, and once it sells, they pay off their reverse mortgage. They then get to bank the remaining equity. So now they have their home that they own free and clear, and they have the remaining equity from their previous home that they can invest, save, do what they want with. Again, all the other same, well, actually now there's no loan because we've paid it off. So, none of the other conditions apply in this case. And here's another unique one, Jack and Karen, age 72. So they own property up in northern Arizona. They want to take out a $100,000 construction loan to build a house. Once that house is complete, it appraises for $300,000. So based on that value, we're able to get them a HECM for about $150,000. So we pay off the $100,000 construction loan. We also give them an extra $50,000 available on a credit line that's going to grow over time. So in this scenario, they built and now will live in their house essentially for free, because they never made a payment on that construction loan, and they don't need to make a P&I payment on their new home. They need to pay property taxes, insurance, and that's it. And they also have $50,000, on a credit line that they have available to them. So this is a really unique. You're not going to run into these every day, but it is a solution that is possible. I mentioned income earlier. I'll just talk briefly about it. What we look at for reverse is called residual income, and it's based on geography, location, and family size. On the next slide, I'll show you in more detail what that looks like. Income can be from employment, Social Security, investment income, pensions, assets. I mean, all your traditional income sources that we would have for traditional mortgage apply. When income levels do not meet HUD guidelines, income from non-borrowing spouses or other household members can be used to reduce the family size in order to qualify. Again, on the next slide, when you see the table, that'll make more sense. There's compensating factors that are considered when income levels are below guidelines, so we can, do some things to still get people qualified. And then, but if income is still insufficient, then we may look at what's called a partially funded LISA, life expectancy set aside. And basically, it's an escrow. So we're setting up an escrow account from proceeds from the HECM that will help close the gap on, being able to cover the property tax, insurance, and any other obligations that the borrower may have. So this is the table I was mentioning. So the way the residual income works, based on the location within the country and based on the number of people in the home, there's a certain residual income threshold that needs to be met. So we are considered in the West region here in Arizona. So if you have a family size of one, you have a $589 residual income. A family size of two is $998, and so on. And what we mean by residual income is basically the income that's left over after we take their total income that's coming in minus the property tax, the insurance, the HOA, and a maintenance calculation. So we basically apply 14 cents per square foot against the property, which figures their monthly utility and maintenance cost. So we take those costs, plus any other obligations if they have a car loan, et cetera. We subtract that and we come up with residual income. And so as long as their residual income meets these thresholds, then they qualify based on income. And so typically what I'm doing with borrowers is, if they have Social Security income, we'll try to qualify them initially just based on that. If that's not going to be enough, then we'll start looking at these other sources. So if they have pensions, if they have dividends coming in off of assets and things like that. I mean, obviously that starts to get more complicated, a lot more paperwork. Then we start getting into tax returns and things like that. But in a lot of cases, we're actually able to qualify people purely based on their Social Security income. And so we'll always take the easiest path when we can. Satisfactory credit, I think I mentioned this at the very beginning. It's not so much the FICO score that's the biggest important here. It's really about showing that housing and installment debt payments have been made on time for the previous 12 months. You've had no more than 2 30-day late mortgage or installment payments in the previous 24. No major derogatory credit on any revolving accounts in the last 12 months. And if there is major derogatory credit on revolving accounts, shall include payments made more than 90 days after the due date, or 3 days, or 3 or more payments more than 60 days after the due date. So these are the key criteria that we're looking at. If they meet the guidelines of satisfactory credit and show the capacity to meet their financial obligations by meeting or exceeding the residual income, then they will not be required to have a LISA. So again, I'll elaborate a little bit on the LISA. Again, think of it as an escrow account, and partially funded, just to summarize, is really if there's an income shortfall and we just need to close the gap. So they got great credit. We trust them that that they'll make their payments, but they just don't quite have enough income. The partially funded LISA is just a gap filler, if you will. The fully funded LISA is really based on credit. So if there are credit issues, it's not to say that we can't qualify the borrower, but we may be required to have a fully funded LISA, which means we take a calculation of the property tax, insurance, HOA, and maintenance costs, and we set up an account where we have to have enough money sitting in that to cover those for the duration, the term of that loan. So again, it's not the end of the world. It just, in a lot of cases, it means that it reduces the amount of proceeds that are available to the borrower. So it may reduce or minimize, the cost of the property that they're looking at. So, just now switch gears here a little bit, just to explain how HECM for Purchase could help, realtors grow your business. Increased purchasing power. So again, as we talked about, makes buying a higher priced home with desired upgrades or amenities easier to afford. You have the ability to capture new customers. Baby boomers age 62 and above don't want monthly mortgage payments, but they're hesitant to use the majority of their assets to purchase a new home. So here's a great solution that can be offered to them that is a good compromise and allows them to do both. You can set yourself apart by being one of the only professionals in your market who's familiar with these programs, and you can sell homes faster. Again, a lot of times people want to wait till their property has sold, so before they get committed to another property. As we talked about in a couple of the different case studies, this can enable you to help your borrowers move into that next property, start that process sooner, even if they still have a contingent property they want to sell. And finally, how to start the conversation. Simply introduce the benefits of the HECM for purchase. Again, one of the key things, it's FHA insured. And so it has all the protections that we've talked about here. It's non-recourse, the borrower retains title, beneficiaries are still going to inherit, and any equity still passes to them. But again, the key thing is, in the unlikely event that, they are in a negative equity position, it's a non-recourse loan. So they don't have to worry about that. One-time upfront investment of roughly 45 to 62% of the purchase price. And again, you saw that in that table that illustrated based on age. You can borrow, when you're younger, you can borrow, 45%, and then that can go up to 62% based on your age. Monthly principal and interest payments are optional as long as the borrower lives in the home. But again, we've talked about the obligation, property tax, insurance, HOA fees, etc. So we have materials that I can provide, both virtual, links to resources and information for borrowers, as well as other collaterals that we're happy to provide to you that you could share with your borrowers. So with that, we can open it up for any questions, Sarah.
All right. Does anybody have any questions for Andrew? I mean, he does such an incredible, thorough job covering this. It's the question that you get all the time is, when can I become 62? That's probably the most common one. Well, if you guys have any questions, put them in the chat, put them in the Q&A. Here is Andrew's contact information as well. So if you don't want to ask questions right now, if you're just processing all of this amazing information, that's okay too. He is available, anytime to answer any of your questions. And like I said, he is the expert when it comes to this. There's a lot of loan officers out there that will take on reverse mortgage, but it may not be the thing that they are the most competent in. And then it can get a little, like I said, it can get a little mucky out there because it is a different program than some of your other traditional FHA, conventional, even VA loans. So if you need any questions, need any information, like I said, reach out to Andrew. He's got it. He has got it. So I'm going to go ahead and finish up with some of the other things that we have coming up. So many great classes at Landmark Title. So, like I said, Andrew, I don't know, I think everybody's mind was blown today. So,
yes, Sarah, well, thank you. I know we covered it really quickly to try to squeeze it into the 30 minutes, but yes, please, if anybody wants information, wants to chat, wants to go through things in more detail, I'm perfectly happy to spend the time. Just reach out, either phone or email, and I'll spend whatever time needed with you.
Yeah, well, and as the baby boomer generation is getting up there in that 60 plus age range, this is one of the hottest places for them to move to. So I think we're just going to continue to see the reverse mortgage coming out as a very useful tool. And a lot of your clients, they don't even know that this is available. So now, those of you who attended Marketing Matters today, and your clients know. Melinda said it was great information, Andrew, and thank you.
Great, thank you.
Oh, we do have a question. All right. How does the loan compound over time? What is owed when the loan comes due? That's a great question.
Okay. Yeah, I mean, it's traditional compounding interest. So, I mean, just like a traditional mortgage, you have your interest that's going to accrue over time, but because you're not making any payments on that, that interest will just continue to grow. When we look at loan options for borrowers, we're able to actually produce both multiple loan options that they can review, both fixed lump sums or adjustable rates, et cetera. And with those, we'll generate amortization schedules, and those amortization schedules will run out over 30, 40 years depending on life expectancy. And we can have assumptions in there. So traditionally, we'll run an assumption of a 4% annual appreciation on the home value. We can look at it at 0. We can look at it at 8%. We have the ability to look at that different ways, and we can see over time, as that loan balance grows, as the home value grows, what's the remaining equity that's still in the property. But again, it's just like a traditional loan, you can either refinance to pay that loan off. You could pay it off in cash. You can sell the home and pay it off, and whatever equity then is left over goes back to the borrower.
Nice.
Hopefully that answers your question.
Yeah, I think so. All right, guys, if you have any other questions, go ahead, throw them up in the chat. I'm going to go quickly through the other classes that we have coming up, and we'll get you out of here. Tomorrow, we have an online CE class on FHA MBA loans. Yay, more loan stuff. Yay. And CE credits. This is for 3 hours of legal issues. This is going to be tomorrow morning, 9 a.m. to 12. It's on Zoom. I love Zoom CE classes. Like, I love in-person classes too. But I got to tell you guys, I love getting the content right in front of me. It's quick, it's easy. You get your credits and you stay up to date with those for renewal. So we've got a lot of CE classes coming up for you before the end of the year, because I know people need to renew before the end of the year. Oh, and that is tomorrow, August 26th. And then also, I think this is also tomorrow. Maybe you've got your CE credits. Maybe you want some more information on escrow 101. This is with Tiffany Hobgood. She is the VP of our escrow operations at Landmark Title. This is an in-person class. This is going to be over in Goodyear. So if you want some more information about escrow and what it is that we actually do over here at Landmark Title, please reach out to Patty and Michael. They'll register you for this class and you can attend it. Then next week, the week after, usually we do market insights on the first Thursday of the month. So I was like very excited, but market stats don't come out until the 2nd, which is the first Thursday. So please note that market insights, which is our monthly marketing stats webinar, will be on September 9th. This is at 9:30. Once again, this is just a quick 30-minute overview of what's going on in our market. And guys, our market is changing so drastically every month. I cannot emphasize enough getting on this market insights and getting the information. We also have all of these slides available if you get on. We also have all of the city market reports. So these are all available to you. We can personally brand them. So reach out to your business development manager to get on market insights or get those personally branded market stats for you to share with your clients. And then I'm super excited about this one. Jessica and I are doing a 4-part, yes, not 1, not 2, not 3, but 4-part video marketing series. I cannot talk enough about video marketing, guys. So we're actually going to do an in-person class, 4 of them, all about video marketing. This is going to be out in the East Valley starting in September. This is going to be at the Bliss Realty office. So if you want to get your video 101 on, some Facebook Lives, you want to get your video 2.0 on and do some actual videos. Yes, we're going to be doing videos with you. if you want to learn how to edit those videos, or if you want to do video reels, you want to learn a little bit more about it. Video reels are hot, guys. Please attend any of these. You don't have to go to all four. You can pick and choose wherever you are in the video marketing status of your business, but we have this wonderful resource available for you. So please reach out to your business development managers if you want to get registered for that. And then we've got an in-person CE class coming up on divorce. Yes, there's a lot of that after the year that we've had. And you guys got to know, you've got to know what to do when you've got clients that are coming to you with divorce. So this is going to be, this is also a CE credit, once again, on legal issues. This is going to be Thursday, September 9th. This is going to be from 9 a.m. to 12 p.m. in person. So if you would like to attend this class, please let us know. Patty and Michael can get you all registered, and you can get some more CE credits. And then Zach and I have a Realtor Mind Tricks class coming up. We couple these with a mastermind. These are really great. This one's going to be over in Goodyear at the Caliber Home Loans location. It's a beautiful office. And this one focuses on building brand ambassadors that are going to market your business for you, right? We pay so much in marketing. This is what Marketing Matters is all about. But what if you could train people to actually be your brand ambassadors and give you referrals? Yes, we're going to tell you how to use the real estate force and get these people to basically work for you. So that is, September 14th. This is going to be a lunch and learn too. So come on out, we'll feed you. 11 a.m., September 14th. And then, do you need a new headshot? Are you still using your 1980s arms crossed realtor headshot? Well, don't worry. Michael and Patty are going to help you out on September 14th at 11 to 1. You can show up and get a headshot, a new headshot. Yay. As we're getting back out there, why not present yourself the way that you really are? COVID, 19 pounds or not. Come out. You're going to look beautiful and get a new headshot. This one is in person, obviously, because you have to be there for your headshot at OnQ Financial on September 14th. If you want more information, once again, just reach out to us. And then I've got a couple more CE classes on Thursday, September 16th. We've got That's Not Fair. This is going to be on fair housing. This one is from 10 a.m. to 1 p.m. Once again, it's on Zoom. So if you want to get registered for this, reach out to your business development managers. We'll get you registered. Once again, let's get these CE credits in before the end of the year. And then we've got one of my personal favorites. We've got Tara coming on to do her solar CE class. This is going to give you 3 hours of disclosure credit. And Tara's solar CE classes are the best. So this one is great because it's going to be on Zoom again. So get registered October 8th. Oh, sorry, this flyer is still wrong. It's actually October 21st. It's a Thursday, and it's going to be on Zoom as well. So if you want to get registered for that, let us know. And that's it, guys. That's it in a nutshell. Lots of things going on. Thank you so much, Andrew, for coming on today. Like I said, if you guys need information about reverse mortgages, he's got you covered. And then thank you, of course, to our business development management team, Beth, Becky, Melinda, Mary, Eric out of Las Vegas, Zach, Patty, Michael, and Jessica. Any information that you do need, remember, we are your partners in your real estate business. So it goes beyond just marketing and making flyers for you. Resources, connections, classes, we do it all. And this is what we love doing in our business. So please make sure to utilize your business development managers. No question, no request is too big or too small for us to do because we love doing it. And then, as always, thank you to Landmark Title for allowing us to bring you Marketing Matters every Wednesday and bringing fantastic guests and information like Andrew, like reverse mortgages. I know I've seen the presentation now twice, and I myself have learned so much about it. So if you need any help beyond your marketing and information and classes, such as escrows, think of Landmark Title. We have 6 offices across the valley to service all of your needs. And that's it for us today, guys.